Good morning, everyone. My name is Sonia Baxendale, and I'm the CEO of the Global Risk Institute. On behalf of GRI, I am pleased to welcome those joining us here in person and those participating online. It's important that we convene these discussions with leaders from across Canada's financial sector at a time of such considerable global economic uncertainty. We acknowledge the land we are meeting on is the traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, and the Wendat peoples, and is now home to many diverse nations, Inuit and Métis peoples. We also acknowledge that Toronto is covered by Treaty 13 with the Mississaugas of the Credit. After the Governor's remarks today, I will be joining him for a fireside chat, along with taking as many of your questions as time permits. For those in the room, you can submit your questions through Slido by using the QR code displayed on the screens or in the cards on your seats. Those online will be able to submit questions through Slido on the right side of your screen. It's my great pleasure to introduce our guest today, although I know he needs little introduction to this audience, as evidenced by the fact that we could barely get him to his seat. Tiff Macklem has served as Governor of the Bank of Canada since 2020. To date, his 7-year term has been marked by extraordinary economic volatility and rapid structural change. As Governor, he also serves as Chair of the bank's Board of Directors and sits on the Board of Directors of the Bank for International Settlements. Well before his appointment, Governor Macklem played an important leadership role on the Global Risk Institute. Alongside then-Governor Mark Carney, now Prime Minister, and the late Minister of Finance Jim Flaherty, he contributed to the formation and launch of GRI, and later became chair of the board. We remain grateful for his insight and his foresight and leadership, and his long-standing commitment to advancing dialogue between the public and the private sectors on risk and financial stability. Governor Macklem also speaks about wearing two hats in his current role, reflecting both his leadership at home and his role in shaping international financial stability discussions. While you all know his first hat very well, you may be less familiar with his second, the one he wears on the global stage. Governor Macklem holds a number of international leadership roles, contributing to global coordination amongst central banks and regulators. Most notably, he serves as chair of the Financial Stability Board Standing Committee for the Assessment of Vulnerabilities, or the SCAV, guiding the global monitoring of emerging financial system risks. And we look forward to hearing more about that work today. These international roles place him at the center of global efforts to safeguard financial stability and underscore the importance of coordination among central banks and regulators worldwide. Today, Governor Macklem will offer a perspective on the evolving financial stability landscape and the broader forces shaping the global economy. He'll reflect on the interconnected risks confronting policymakers and market participants alike, and the importance of coordination in an increasingly complex environment. In the past, the Governor has been clear that safeguarding financial stability is not the work of central banks alone. It requires a strong, resilient private sector and ongoing dialogue between regulators and financial industry leaders. Following his remarks, the Governor will join me for a fireside chat when we will all have the opportunity to explore these themes further. Governor Macklem, thank you for being with us today. We look forward to your remarks.
Well, thank you, Sonia. It's a real pleasure to be here. Sonia, you forgot to mention my most important accomplishment, though, over many years, and that was I was chair of the board of GRI when we hired Sonia. So look, it's great to be back, and it's a real pleasure to be part of this risk symposium. It's wonderful to see such an impressive mix of market participants, policymakers, and practitioners. And I am looking forward to our fireside chat. So I'm going to try and keep my remarks short and leave more time for the conversation. I will say conversations like this matter, especially when uncertainty is high and we're all trying to manage the risks. As we speak, the actions taken against Iran by Israel and the United States have increased volatility in energy and financial markets considerably, and there's a lot of uncertainty about the duration and fallout of this conflict. My focus today, though, is going to be on some longer-term changes we're seeing in the financial system. And I'm here today, as Sonia mentioned, really wearing two hats. Of course, I'm always governor of the Bank of Canada. I am also chair of the Financial Stability Board's Standing Committee for the Assessment of Vulnerabilities, or as Sonia said, SCAV, as we call it. The role of SCAV is not to predict the next financial crisis, and it's not to prescribe policy. The role of SCAV is really to step back and to connect the dots across markets, across jurisdictions, to identify the systemic vulnerabilities. The goal is to understand the pressure points so they don't become fractures. The global reach of the FSB complements the work of domestic regulators and central banks. It does that by giving us that international dimension. It also complements the work of the private sector. Market participants generally do a good job of managing the risks they face individually. But systemic risk can build beyond the sightline of any single firm. We all have a stake in a well-functioning financial system that channels savings to productive investments and helps businesses and households manage their own risks. But to work well, the financial system needs a competitive marketplace, it needs clear rules and good information. And because money moves across borders, the perspective needs to be global with a degree of international coordination. I'm going to start today with a quick overview of the broader risk landscape, and then I'm going to dive in and go a little deeper on the growth of new players, and in particular, two areas of risk where SCAV has been paying a considerable amount of attention. First, leverage trading by hedge funds in government bond markets, and second, the rapid growth we're seeing in private credit. My goal is not to alarm, but it's to shed light on the systemic nature of these risks. It's to highlight the need to close data gaps, and it's to deepen understanding. The aim is not to impede the private sector, it's to help the private sector what it does best, seek return while managing risk. So let me start with the economic backdrop and the risks to the outlook. Despite trade disruptions and geopolitical risk, global growth has actually been quite healthy. The Bank of Canada's latest forecast has global growth continuing at about 3%. But risks are greater than normal, and they look tilted to the downside. Geopolitical risks are high, with multiple conflicts playing out. Uncertainty about U.S. trade policy also remains elevated. Global growth is being supported by a boom in AI and fiscal stimulus, but both could run into limits. Advances in AI and digital innovation have the potential to boost productivity and growth, but if the impact of AI is less profound or perhaps more disruptive than expected, growth could slow. Fiscal flexibility is limited by high levels of sovereign debt, and we are seeing term premium on government bonds has increased. In equity and credit markets, we're seeing compressed risk premiums and stretched valuations. This raises the risk of sharp reversals and increased volatility across asset classes. These risks could also interact with vulnerabilities in the financial system. After the global financial crisis, we strengthened the regulation of banks, and that made the system safer. As a result, riskier activities have migrated to non-bank financial intermediaries. And this growth in market-based finance has brought clear benefits: diversified risk, improved access to credit, and increased efficiency. But risks have not disappeared. They've migrated too. And our global surveillance and regulatory frameworks haven't kept pace with the change. Our oversight was built for banking. Non-bank players generally don't have the same reporting requirements or levels of monitoring. That gap poses a challenge for global standard setters, national regulators, and central banks. So with that backdrop, let me turn to two areas of rapid growth in non-bank finance that have our attention. And I'll start with leveraged trading of hedge funds in sovereign debt markets. As governments around the world have issued more debt, non-bank financial intermediaries, particularly hedge funds, have become very large buyers of sovereign debt in many jurisdictions. They hold a large share of privately held government debt across FSB member countries. In Canada, they purchase up to 50% of government bonds sold at auction, and they account for a big proportion of secondary market trading. In short, they've become central to how sovereign markets function, both globally and here in Canada. Their participation has important benefits. Hedge funds help distribute large volumes of issuance to end investors. They support liquidity and price discovery. And as their name implies, they hedge risks. Bond purchases are often covered by short positions in future contracts or interest rate swaps. And that allows them to profit from small pricing inefficiencies. Now, in normal times, hedge funds' participation makes the market work more efficiently. The issue is what happens in times of stress. Hedge fund purchases of sovereign debt are usually highly leveraged. The funding is largely through repurchase agreements, repo markets, and typically it's very short term. Globally, about half have an overnight maturity, and haircuts are low, 0 or negative in more than 80% of the time. This leverage allows hedge funds to earn attractive return from small pricing discrepancies through basis trades and other relative value trades. This improves the efficiency of bond markets. But it also means the system is more sensitive to disruption. Higher funding costs or reduced access can force the positions to be unwound. Leverage can build up quietly and then unwind very quickly when conditions change. One scenario we worry about is a shock to markets that leads to a spike in interest rate volatility, which causes lenders to increase haircuts or curtail funding. And because repo funding is very short term, that adjustment can happen very fast. If leveraged investors are forced to reduce their positions, they may need to sell sovereign bonds into already stressed markets. Prices fall, liquidity deteriorates, and stress feeds back on itself. We've seen examples of this already. The dash for cash at the start of the pandemic, during the UK gilt crisis in 2022, and during the period of stress in treasury markets last spring. The basis trade and other relative value trades are generally low risk for investors. But the scale of these trades and the speed at which they can unwind pose systemic risks. Short-term funding strains could cause severe dislocations in sovereign debt markets. And they are, after all, the backbone of our financial system. And the cross-border nature of markets means that stress that begins in one jurisdiction could move to another. As hedge funds take on a growing role in government bond markets, it is increasingly important that they have robust funding arrangements and sufficient liquidity to weather periods of stress. Public authorities also have some work to do. At the FSB, our first goal is to deepen understanding. That means better data on where leverage is building, how funding is structured, and how exposures are distributed across institutions and borders. And it means sharing this information across jurisdictions and with the private sector. Market-based finance is inherently cross-border. No single authority has a complete picture, so information must be pooled and shared. There's also a need to strengthen infrastructure so that repo markets continue to function in periods of market stress, and shocks are absorbed rather than amplified. Central clearing has the potential to both make access to repo funding more stable and to improve efficiency by increasing opportunities for netting. Major jurisdictions are making important investments. The SEC has mandated that most Treasury collateralized repo transactions be centrally cleared by June 2027. The EU is also looking to increase the share of centrally cleared repos, and the ECB will centrally clear some of its operations this year. With through-the-cycle margining practices, this should improve repo market stability. Here in Canada, the TMX is building a domestic tri-party repo solution. The Bank of Canada plans to use this infrastructure for its domestic repo operations by early next year. Additionally, once the TMX makes the necessary investments into its fixed income clearing infrastructure, we intend to centrally clear our own repo operations. This will make central clearing more attractive for market participants. These infrastructure improvements should also provide greater confidence that markets will keep working under stress. Okay, the second area I want to focus on is private credit. What is private credit? Private credit is non-bank lending to firms, and this includes direct lending by both large institutional investors and investment funds. The market has grown quickly, with a global footprint that now measures in the trillions of dollars. Growth in Canada hasn't been quite as fast, but Canadian pension funds and insurers are active, sophisticated players, and they have private credit exposures internationally. Private credit fills real gaps. It provides financing to companies that may not be well served by traditional banking or public markets. It offers faster execution, more tailored structures, longer-term capital commitments, and greater flexibility for borrowers with complex or unconventional needs. It has increased competition in credit markets and broadened access to funding, and it's playing an important role supporting new investment cycles. Private credit is expected to be an important source of debt funding needed to grow AI infrastructure. The issue is not with private credit itself. It's how private credit will behave under stress and the risks this poses to the broader financial system. Engaging those risks isn't easy. We don't have a lot of history. Private credit hasn't been through a full economic downturn. Like public and bank credit, it carries risks involving credit quality, underwriting standards, and the amount of total leverage taken on by firms. But private credit is also intrinsically more opaque. Unlike public credit markets, private credit positions are not regularly marked to market. Assessing underwriting standards, covenant quality, and the true degree of embedded leverage can be difficult. Liquidity is also more limited. There can be a mismatch between investors' desire to exit and funds' ability to accommodate that. Further, it can be hard to connect the dots across the system, both within the private credit sector and between private credit and the rest of the system. The opacity of private credit means investors may not have enough information about the quality of the loans held in their funds. A spike in defaults could prompt them to try to exit their positions quickly. This could cause severe strains, including spillovers to public credit markets. Again, as with hedge funds, the concern is how stress in private credit could transmit to the core of the financial system. Banks and issuers are linked to private credit through lending, sponsorship, warehousing, and risk transfer. That means weaknesses in private credit could spill back into the regulated sector. And because private credit is increasingly global, those spillovers could travel across borders. We've recently seen a few signs of strains in private credit markets. Although the recent high-profile defaults were contained, they have raised questions about the quality and transparency of underwriting. At the FSB, we're working to improve understanding and the monitoring of private credit. Regulatory authorities need visibility into leverage, liquidity transformation, and underwriting practices. And we need to understand the internet connections between private credit and banks. Surveillance needs to be enhanced so we can monitor how risks evolve as this market grows. That includes tracking cross-border exposures, funding structures, and the potential for correlated stress across institutions and jurisdictions. And once again, global coordination is critical. Private credit sits at the intersection of markets and institutions, so we need cooperation across authorities and across borders. Okay. I'm looking forward to the discussion. So let me wrap up. The rise in non-bank players in global debt markets is not a problem to be solved. The growing participation of hedge funds and private credit in global finance is part of a healthy financial system. Mais ces nouveaux acteurs en pleine croissance amènent des risques qui méritent plus d'attention. Les risques pourraient augmenter plus vite que notre capacité à les comprendre et les atténuer. L'incertitude économique est déjà élevée. On ne peut pas se permettre d'ajouter de l'instabilité financière. On compte sur le secteur privé pour être la première ligne de défense. À mesure qu'on va mieux comprendre les risques systémiques, il sera important de communiquer avec vous. Et on doit travailler main dans la main pour renforcer l'infrastructure des marchés financiers essentiels. Ensemble, on peut faire connaître les enjeux et bâtir la résilience. Quand les tensions vont survenir, tout le monde devrait être prêt. New and rapidly growing players bring risks and vulnerabilities that need more attention. Risks may be growing faster than our ability to understand and mitigate them. Economic uncertainty is already high. We cannot afford to add financial instability to the mix. We are counting on the private sector to be the first line of defense. And as we gain understanding of the systemic vulnerabilities, it's critical that we communicate with you. And we need to work hand in hand to strengthen core financial market infrastructure. Together, we can raise awareness and build resilience. So when the stress comes, because when the stress comes, we all need to be ready for it. Thank you very much.
Okay, wonderful. Thank you. I already have a few questions, so please, if there's anything you'd like to raise with the governor, please do so. Although my iPad seems to have just decided to conk out, so maybe I'll get Jill to fix that for me. Thank you. Wonderful.
It's a risk institute. They've got a backup plan.
We got multiple. Anyway, and I've got paper. Always have paper. Anyway, let me just kick this off. I always like to take the first opportunity to ask a couple of questions. So, Governor, I suspect for many people in this room, SCAV is something we've heard for the first time today. So maybe just, and you did talk about its mandate, but how does it operate and how does industry either get information out of it or contribute to it?
Okay, good question. So to explain SCAV, maybe just give you a snapshot of the FSB. So it's a bit of an oversimplification, but there are three key standing committees at the FSB. There is SCAV, the Standing Committee for the Assessment of Vulnerabilities. And as its name suggests, it's about looking at the risks and the vulnerabilities in the global financial system. The second one is the Standing Committee for Supervisory and Regulatory Coordination. I think of that as the policy committee. Where there are risks, vulnerabilities, SCAV might refer those to the policy committee. I chair SCAV, Mickey Bowman at the Fed chairs what's known as SRC. And then the third committee is the Standing Committee for Standards Implementation. And what that does, it assesses how well countries are implementing the standards that have been agreed and what sort of impacts those are having. So you can think of, it starts with vulnerabilities, then there's policy, and then there's implementation. So coming back to SCAV, yes, I mean, I would say that the focus is more macro-financial and it's more systemic. We're particularly interested in how vulnerabilities in one part of the system could have knock-on effects, spill over and spread to other parts of the system. There's obviously an important international dimension. And I have to say, to me, that is one of the real values of the FSB. Domestically, hopefully you have pretty good line of sight within your border, but it's hard to have line of sight beyond your border. And so being able to connect what's happening here with what's happening elsewhere is hugely important. And obviously there are big international players that are here operating in Canada or investing, trading Canada. Having that line of sight is critical. As I said, it's not about trying to predict the next crisis. SCAV's job is not to prescribe policy. Where we do see issues, we can refer it to the policy committee of the FSB. There are also the standard setters. I'm certainly in contact with the Basel Committee, for example. And what I would stress is the post-GFC reforms have strengthened the resilience of the financial system. And I think, despite everything we've been through in the last number of years, the financial system has held up very well. But the system is changing. It is evolving. That's a good thing. But we need to keep up. We need to make sure we understand those risks. You need to make sure you understand those risks. And that's where the FSB, I think, can play a role. We do have, SCAV does have regular outreach with the private sector. In fact, we had a meeting here last fall. I brought in a number of leading hedge funds and private credit players here in Canada so that we could hear directly from market players. And where, where you'll see things from us, we just published what we call a deep dive study. It's, probably 30-page study on repo markets. So there's a lot of, it really does connect the dots globally. I learned a lot, as we undertook this work. So I mean, I think you want to sort of watch the stuff that is coming out of the FSB.
Thank you. That's very helpful. So I'm going to be a little provocative out the gate. Sorry. In your comments, you referred to scale and speed frequently. How can we think about the regulatory, even when you describe the committees, the process, the global, the national, how can we rely on the regulatory structure and system to keep pace with the speed of which things are changing? It's one thing for industry, but I think it has to be both sides of that coin.
Well, look, I think it's a real issue. I think certainly from the perspective of the FSB, Andrew Bailey, who's chair of the FSB, I chair SCAV, we are committed to strengthening the surveillance function. I think look, the reality is we're in a world that is more uncertain. There are more risks. Against that background, there is going to be a real premium on understanding the systemic nature of those risks. And the reality is there's not going to be a regulatory response for every problem. The pendulum, for one thing, is kind of swinging away from regulating everything to taking a more targeted approach. That means, we're going to be relying importantly on the private sector to make sure to be that line of defense. And the basics of risk haven't changed. Leverage, capital, liquidity. But the systems there are new players. That is making the system more complicated. It's bringing benefits, it's bringing diversification, it's creating new access, but it is also bringing new complexity. It's also creating new interconnections. And the reality is, as it becomes more complex and there's more interconnections, it can be easier to hide leverage. That puts a premium on your due diligence. Make sure you really understand the risks that you're taking. Think about not just how things are working in normal times, but think about times of stress. I know you do, but think not just about, don't think about that narrowly. Think about what could the knock-on effects be. We, I think, have an increased responsibility to try to understand those. We get it. It's hard for you as an individual firm to have that macro financial perspective, to see those systemic consequences. So that's our focus, and we will be doing our best to uncover those and to communicate with you. Look, we're going to have to become more nimble. World's changing faster. We got to catch up. We got to keep up.
Yeah, well, we all are struggling to keep up with the amount of changes. I had breakfast with Michael Zerbs yesterday, and in our conversation, we said the focus would be different depending on whether we had the conversation with you this week or last week or the week before, in terms of how things are changing so quickly. You've talked a lot about the new players that have come into the market, and if you're a member or an employee of a regulated institution, you often bemoan the fact that the non-regulated or less regulated or differently regulated have an advantage in the system. And I think maybe there's a sense that there's more innovation in some portions of this ecosystem. What are your thoughts on how, and all of the parts of it serve a purpose, and a valuable and an important purpose in this ecosystem? How do we ensure that the asymmetries actually work, as opposed to, trying to have a one-size-fits-all for everybody here?
I can tell you from experience, if you're in the regulated sector, you bemoan the new players. If you're the new players, you bemoan the incumbents. There's a lot of bemoaning. Look, I think the reality is, to go back to something I said, I don't think we see regulation as the solution to every problem here. There are real benefits to these new players. And keep in mind, when we reformed, the post-GFC reform, they were deliberately trying to drive some of the riskier activities out of banking to other parts of the system. This isn't an unintended consequences. This was deliberate. What we need to make sure, though, is that they don't inadvertently come back into the core of the system. Take private credit. One of the things you can see from the hairline cracks we've seen in private credit and those recent defaults is that the fact that the exposures to private credit are well known, but actually banks also had direct loans to some of those players that are bankrupt. They also had revolving or funding some of the private credit players, and they were also lending to some of the investors that were invested in private credit so they could take on leverage. So now these were very contained, but it does show that yes, there is a risk that things come back around. So, you know, I don't think we're going to try to regulate market-based finance like we regulate banks. They don't take deposits. You know, there's good reasons for that. But we do need to make sure that when risks are diversified, they are truly diversified and they are not spilling back. And that gets back to trying to understand the linkages and the systemic consequences. Part of that, and look, part of it is, you know, if we understand it, we share it, market players understand it, they take that in consideration as they manage their risks. Part of it has got to be also ensuring that our sort of core financial market infrastructure is evolving in line with the growth in certain parts of the system. So certainly, you know, the much bigger footprint of hedge funds in sovereign debt markets and the fact that they're funding a lot through repo markets, that is putting a lot of focus on ensuring the infrastructure around repo markets is up to the task. So you know, I think, you know, before we, you know, there are, I'm not saying there won't be any regulatory responses, but, you know, given that there are important benefits, you know, before you jump to regulation, you got to make sure you really understand where the leverage is, who, you know, where the counterparties, where the potential spillovers, and that's really, you know, where we are now.
Great, thank you. I want to turn to a couple of questions, many of which relate to private credit. So just one question, and you've talked about private credit, and it's really a global issue. Are there particular markets where, as a group, when you get together, that you see greater risks emanating from, or particular sectors? How are your discussions unfolding in relation to that?
Well, I mean, we're still gathering better information, but you know, I think when you look at the, you know, the broader risk landscape, there is some potential for some interaction between some of these risks. So we've seen a real boom in AI. AI, look, there's no question, it's a general purpose technology. It holds tremendous potential to improve productivity, raise standards of living, strengthen growth. But, you know, exactly how quickly that plays out, how it gets distributed, what sectors are more disrupted than others, that, you know, there's a fair amount of uncertainty around that. You know, a lot of the funding, certainly prospectively, looks like private credit could play a big role in the funding of that build out. So, you know, there's some potential interactions there. So, you know, that's the sort of thing where, look, if one thing goes wrong, if two things goes wrong, that's not usually a big problem. It's when multiple things go wrong and they knock on to other things, that's when it becomes a bigger problem. So that's what we're really watching for.
Great, thank you. A question around the interactions of the BIS and FSB, and I think this ties into that sort of learning from each other. Are you now meeting more frequently? Is the agenda changing in terms of how you're thinking about the risks in those kinds of collaborations?
Well, just a word on the BIS. So the Bank for International Settlements is kind of the central bank for central banks. And the governors do meet regularly at the BIS 5 times a year. In fact, I'm going to Switzerland this weekend. And I can tell you in you know, the 5+ years I've been governor, every meeting there's something new on the agenda. And it has been tremendously valuable to you know, share perspectives, share information with my governor counterparts. You know, so many of the issues we've faced over the last number of years have been global. We're all kind of dealing, yes, we have different exposures, but we're all dealing with the same thing, and you know, seeing how it's playing out in jurisdictions, understanding how different central banks are thinking about responding has been tremendously helpful. The second thing I'll mention, just at a practical level, is the FSB. Like, where is the FSB? Well, the FSB is actually housed in the BIS, so they're all in the same building, and they do work closely together. The researchers and analysts at the BIS, talk regularly, often do joint work with the Secretariat of the FSB. And I mean, the other element of the FSB that's important is that the FSB, it's a member organization. The Secretariat plays a key role and brings a lot of expertise, but a lot of the work is done by the members, in various working groups. Various working groups that bring experts in the central banks together to work on various issues, and I think that has been a real strength, both the interaction with the BIS and also the sort of member basis of it.
Great. So I have a number of questions about how the Bank of Canada is factoring in some of the events taking place. So I'll just zero in on two which seem to be coming up the most, and that is how you're factoring in the tariff discussion, the CUSMA discussions, probably most relevantly, and also the current Middle Eastern situation.
Well, the first one's probably more of a monetary policy question. So we actually, in our last monetary policy report, we had an appendix that sort of outlined a range of possible outcomes for CUSMA. I don't think I need to take you all through those, but how are we managing the uncertainty? For a while, when Trump first came out with various tariff threats, there was just so much uncertainty. We didn't even publish a forecast. We published scenarios, low tariff, high tariff. Our last monetary policy report, we did go back to a forecast, and we're very clear that forecast is based on the tariffs that are in place now just staying in place forever, permanently, or over the forecast horizon anyways. And obviously, there's still a lot of uncertainty. Tariffs, change weekly. So that's probably not things are probably not gonna come out exactly based on, in line with that assumption, but it is the obvious baseline at which you're gonna evaluate new developments. We have done and we have published a range of different scenarios. We've found those very useful from a policy perspective as we think about policy decisions that are at least robust to a range of scenarios. And because we found them useful, we thought you might find them useful, so we have published those. We've indicated that based on the forecast we've published, we think the current policy interest rate is appropriate. We've also indicated that if the situation changes, and in particular if that has a material impact on the outlook, we are prepared to respond. With respect to the conflict we're seeing in the Middle East, we're 5 days in. It's early days. We're certainly monitoring the situation closely. I mean, what I can tell you in terms of the market response globally, I have been talking to my colleagues. I mean, what you're hearing is, look, we're all seeing markets are repricing. To this point, markets have been functioning. There's no dysfunction in markets. It's repricing. Markets are relatively orderly. I think there are two kind of key things playing out in the market. This is an energy price shock. Oil prices are up. Natural gas prices are up. And countries that are big importers, particularly if they import through the Strait of Hormuz, are being the most affected. It's also a risk sentiment shock. And so you're seeing some flight to quality. You're seeing risk assets trade down. There are both of those elements, and I think how this plays out is going to depend importantly on the duration, how broad it is, and the final thing I would say is, markets do not capture the human cost of these conflicts, and we can't forget about that.
Yeah, thank you. Building on that a little bit, just given the geopolitical fragmentation that we have now and the complexity of, how do you feel that the multilateral framework of collaboration and cooperation is going to hold up during a period of stress?
That's a good question. Let me say a couple things. One is, international cooperation has never been easy. It's getting harder. Let's be frank about it. It is getting harder. It is particularly critical when you're looking at financial stability. When you think of, much of the focus has been on trade. Well, when you're trading in goods, it's got to go in a ship, or it's got to be physically transported. It physically crosses a border. And if you want to ship less to one country, well, potentially you can develop new relationships and ship more to another country. Finance, money moves at a click of a keystroke. Money is a lot more fluid. So, agreeing on some minimum standards globally is critical to the stability of the system. My sense is that, yes, it is getting more difficult, but I think everybody sees the benefits of minimum global standards. Everybody sees the benefits of, financial stability. It's a global public good. Nobody wants a financial instability problem. We all know we're all connected. So, to this point, the FSB in particular continues to operate. The U.S. is chairing the G20 next year. They've certainly been engaging the FSB on a number of important elements. So, yeah, look, is it getting harder? Sure, it's getting harder. It's more important, though, than ever. And it's getting harder. We're going to have to work harder.
Yeah, I think that's a fair statement. We're getting close to the end of our time, so I want to wrap with a question and bring us back to Canada. And very importantly, you talked about public-private partnership, our working together. And I think we view our industry and our regulators and our government have a working relationship in Canada in the financial sector that I think is unique in the world in terms of the level of engagement. What do we need? What should we collectively be focusing on right now in this time of challenges?
Well, first of all, I want to underline your first point. I do think we have a cooperative spirit where, I think the public sector recognizes we don't have all the answers. The private sector, I think you recognize you don't have all the answers. But when we put our heads together, we're going to be much further ahead. And particularly, our model in Canada for developing key parts of financial market infrastructure, it is a very cooperative model. We work closely with industry. You own most of it. It's your infrastructure. You pay for it. And we work together to try to have both an efficient and stable system. And I think that that is something that we do need to celebrate and not forget. In terms of priorities, one of the risks we haven't talked a lot about yet is operational risk. That includes cyber, that includes technological disruptions. other events. And look, I think the operational risks have been appropriately getting more attention, and certainly we rely very heavily on boards, on management to set the right risk culture, to do testing, to do contingency planning, and particularly in an environment where there's more global conflict, focus on those operational risks it needs to be heightened. From a systemic point of view, one of the I think, challenges on the operational side is there are a relatively small number of key third parties that many of you rely on, support key parts of the infrastructure, both here in Canada and globally. And you do need to be thinking about if there's a problem with one of those, it's not just going to affect you, it's going to affect many of your counterparties. So there are systemic elements there too. And the other thing I will mention is sort of coming back to some of the themes I talked about. There are important data gaps in terms of our ability to see where the leverage is, where the connectivity is. I think we need to increasingly work together to share information on where those risks are. Also, what are the potential policy levers? As I said, there are a lot of benefits of private credit. There's a lot of benefits. Governments are selling a lot of bonds. We need hedge funds. The system needs hedge funds are doing a very good job of buying them, distributing them. We want to make sure that they're there in every state of the world. We're not trying to curtail it. So what are the best ways to do that? Those are important conversations that we need to have.
Wonderful. Thank you. Well, I know we could go on for much longer. So thank you very much for always being available, except during blackouts, of course, for your candor, for engaging with industry. I know you're always open to having input and having the dialogue. So we really appreciate that, and it's a privilege to have you here with us. I am going to call on the chair of GRI board, Billy Bonnell, to come up and say a few closing remarks.
Thank you very much. Merci beaucoup, Sonia. And thank you, Governor Macklem, for sharing generously your insights and perspectives with us today. While these are uncertain times for both Canada and the international markets, we can take some comfort in having you as a thoughtful, steady hand at the tiller, both in Canada and on the global stage. So thank you. As we witness the shift from a collaborative, norms-based global order towards a more transactional world, it is more important than ever to reaffirm our commitment to cooperation on challenges that no one country can solve alone. Governor Macklem brings a uniquely Canadian perspective to international forums like the BIS and the FSB, helping ensure that global standards on capital, liquidity, crisis management, and emerging risks reflect real policy trade-offs, not just the priorities of the largest economies. In an era of fragmented geopolitics and tightly coupled financial systems, his brand of credible, bridge-building leadership matters. And a brief note of acknowledgement: when Governor Macklem spoke publicly earlier this year in support of the independence of central banks, many Canadians welcomed his clear affirmation that monetary policy decisions should be based on evidence and not politics. It was a principled stand and an important one for global financial stability. Governor, thanks again for sharing your time with us today. It is very much appreciated. You've been a friend of GRI from the very early days, and it's greatly appreciated. And thank you to everyone present in the room and participating online as well for your questions and your engagement with the Global Risk Institute. We look forward to continuing the dialogue that we've begun here today. So thank you and merci.
Thank you.